There's a moment that happens to almost every long-term property investor. They're sitting down, looking at a monthly bank statement, and they realize that money arrived in their account while they were asleep, while they were at dinner, while they were on vacation. And it didn't come from their job. It came from a building they own. That moment changes how a person thinks about money permanently. And the path to getting there is more accessible than most people ever realize, but also more complicated than most people are told. This is the full picture of building wealth through property ownership and rental income. Not the highlight reel. The real mechanics, the real risks, and the strategy that actually works over time. Let's start with why real estate has been one of the most reliable wealth-building vehicles in human history. Unlike stocks, which represent ownership in a business you have no control over, real estate gives you a tangible, physical asset that you can improve, manage, and leverage. It does several things simultaneously that almost no other investment can claim. It generates monthly cash flow through rent. It appreciates in value over time. It builds equity as tenants essentially pay down your mortgage. It provides tax advantages that reduce your overall burden. And it acts as a hedge against inflation, because as prices rise, so does the value of your property and the rent you can charge. That combination, cash flow, appreciation, equity buildup, tax benefits, and inflation protection, is called the 5 pillars of real estate returns. Each one alone is a decent investment reason. All 5 together, stacked on a single asset, is why serious wealth builders have used property for generations. Here's how the core model works. You purchase a property, let's say a modest 2-bedroom house. You put down a percentage of the purchase price, typically 20% for an investment property, and borrow the rest through a mortgage. You then rent that property to a tenant. The tenant's monthly rent payment covers the mortgage, the property taxes, the insurance, and the maintenance costs, and ideally leaves money left over. That leftover amount is your cash flow. That is money your tenant is generating for you every single month. Meanwhile, 2 other things are happening quietly in the background. First, a portion of every mortgage payment goes toward paying down the loan principal. Every month, you own a little more of that property outright. This is called equity accumulation, and it happens whether the property increases in value or not. Second, over time, the property itself tends to increase in value. Historically, U.S. residential real estate has appreciated at around 3 to 4% annually on average, more in high-demand urban markets, less in slower regions. That appreciation builds wealth that you access when you eventually sell or refinance. Now let's talk about leverage, because this is what makes real estate genuinely different from most other investments. When you invest $20,000 in stocks, you control $20,000 worth of assets. When you put $20,000 down on a $100,000 property, you control $100,000 worth of real estate. If that property appreciates 5% in a year, you haven't made 5% on your money. You've made $5,000 on a $20,000 investment, a 25% return. Leverage amplifies your gains in a way that almost no other accessible investment vehicle can match. It also amplifies losses, which is why understanding the numbers before you buy is non-negotiable. This brings us to the concept every serious real estate investor lives by: cash flow analysis. Before purchasing any rental property, you need to know your net operating income, which is the total rent collected minus all operating expenses like taxes, insurance, maintenance, vacancy allowance, and property management fees. Then you subtract your mortgage payment. What's left is your monthly cash flow. If it's negative, the property is costing you money every month. If it's positive, the property is paying you. A useful quick metric is the 1% rule. If the monthly rent is at least 1% of the purchase price, the property has a reasonable chance of cash flowing. A $150,000 property should ideally rent for at least $1,500 per month. This isn't a guarantee, but it's a fast filter to separate properties worth analyzing from those that aren't. Location is the variable that overrides nearly everything else in real estate. A well-maintained property in a declining area with falling population and weak job growth is a trap. A modest property in a growing city with strong employment, good schools, and limited housing supply can build enormous wealth over time. Before you buy, study the local economy. Look at population trends, job market diversity, rent-to-price ratios, and vacancy rates. The asset matters. The market it sits in matters more. Speaking of taxes, this is an area where real estate genuinely stands apart. The tax code in most countries, and particularly in the United States, is strikingly favorable to property owners. Depreciation allows you to deduct a portion of your property's value each year as a paper expense, even if the property is actually increasing in value. This can offset your rental income significantly, reducing or even eliminating your tax liability on that income. Mortgage interest is deductible. Repairs and operating expenses are deductible. And when you sell, a strategy called a 1031 exchange allows you to roll your gains into a new property and defer capital gains taxes indefinitely. But here's what the rental property highlight reels on social media never show you. Being a landlord is a business. And like all businesses, it comes with problems. Tenants miss rent payments. Appliances break at inconvenient times. Properties sit vacant between tenants. Repairs cost more than expected. These are not exceptional circumstances, they are regular features of owning rental property. The investors who succeed long-term are the ones who build these costs into their analysis before they buy, maintain cash reserves to handle them without panic, and treat the property as a business from day one rather than a passive income fantasy. The entry point is lower than most people assume. You don't need to be wealthy to buy your first rental property. You need a reasonable credit score, a sufficient down payment, a property that cash flows, and the patience to let time do the heavy lifting. Many first-time real estate investors start with a house hack, or a modest single-family home in an affordable market, and build from there. Property ownership is not a get-rich-quick strategy. It's a get-wealthy-slowly strategy with a track record that spans centuries. The people who started 5 years ago and wish they'd started earlier, they all say the same thing. The best time to buy was years ago. The second best time is now. Here's what I want you to do before you close this video. Write down one number, the amount you could realistically set aside over the next 12 months toward a first property down payment. It doesn't have to be the full amount. It just has to be honest. Because the investors who built portfolios that changed their lives didn't start with a perfect plan. They started with a number and a decision. Everything else came after. If this video gave you clarity on something you've been thinking about for a while, hit the like button. It genuinely helps more people find this content and start asking the right questions about their money. And if you're not subscribed yet, now is the right time to fix that. Every week we break down exactly how wealth is built, not the watered-down version, not the highlight reel, but the real mechanics behind the decisions that separate people who build lasting financial freedom from those who stay stuck. Subscribe, turn on the notification bell, and you won't miss any of it. The next video is already up, and if real estate is on your radar, it's the one you need to watch before you make any moves.